So tonight's topic is small business tax tips for a COVID economy and beyond. Our presenter tonight is Chris Peterson, and Chris is the tax manager at CB Smith and Associates. CB Smith and Associates is a full-service accounting firm focused on providing business advisory, business accounting, and individual tax services to its clients in Georgia and across the country. They have offices in Cumming, Macon, and the Lake Oconee areas. Chris has over 20 years of experience in tax planning and compliance for businesses and business owners. Chris received a Master of Taxation with specialization in corporate and partnership taxation and a Master of Professional Accountancy with specialization in accounting information systems from Georgia State University, as well as a Bachelor of Business Administration in Public Accounting and Finance from Georgia Southern University. He enjoys reading and spending time with his wife and kids. So now I'm going to hand it over to you, Chris. I will share my screen so that we can see the presentation.
Okay. Oh, there it is.
Oop.
Okay. Okay. Happy Tax Day, everybody. Thank you all for joining in on today's discussion. I want to thank the Forsyth County Public Library for reaching out to me to discuss the topic of taxes in small business. Whether you have been a small business owner for a while or are just thinking about starting one, I hope to offer you insight that will help strengthen your business plans. I will be happy to take your questions at the end of my presentation. Next slide, please. Owning a small business often means doing many run-of-the-business tasks yourself. While wearing all the hats might seem like a smart way to save money, certain things are best left to the professionals, especially accounting and tax planning. Hiring an accountant might be an extra expense, but doing so is well worth it in the long run. The right accountant can not only provide support to maintain your business financial health, but also help you avoid fines and potential problems when you file tax returns and submit financial records for other purposes. Next slide. COVID introduced a whole bunch of new hardships and challenges to many aspects of our lives and our businesses. New legislation and laws were passed, and it was like drinking out of a fire hose to understand everything. As tax and accounting professionals, it was a lot to keep up with, but our team continued through it all to help our clients. Everything from the CARES Act to the American Rescue Plan Act of 2021, we have helped every step of the way by helping clients with information needed for PPP loans and economic injury disaster loans to make sure all deductions and credits were taken for their individual and business tax returns. Next slide. As we are heading closer into a post-COVID world, continue to stay on top of new legislation and laws and be mindful of your company's income and expenses, as well as cash flow. And when it comes to tax planning, my focus as senior tax manager at CB Smith and Associates, let's start at the very beginning. Next slide. There are four basic business structures: sole proprietorship, limited liability company, S corporations, and C corporations. Being set up initially into the right kind of business structure for the type of business you operate is key for yielding the tax efficiency. In the next few slides, I will cover the selection process of a business structure along with pros and cons of each option. Next slide. Small business tax reform is often accomplished by providing incentives at the individual tax level. Most small businesses are taxed at individual rates. A sole proprietorship is the most basic structure that satisfies the needs for many small single owner businesses who are not concerned about asset protection. There is a very limited setup process to being a sole proprietorship. Profits flow to the owner's tax return and are taxed at individual tax rates. Next slide. So for sole proprietorships, it's very easy to set these. There's really hardly any setup at all to these. There's really no separate tax ID number needed. It's generally reported under the business owner's Social Security number. You'll want to have a separate account. You just go to the bank, you set it up on your Social Security number. You don't really need an EIN. The only way you would need an employee identification number, also known as an EIN, for a sole proprietorship would be if you were to ever have employees. Most sole proprietorships, do not have employees. Some may, but very limited number. So there's no separate tax return requirement for a sole proprietorship. In general, all income and expenses again flow through to the individual owner on a Schedule C, which there's a Schedule C attachment to your personal tax return. The biggest drawback to a sole proprietorship is the self-employment tax. And this is a tax that can cause damage as profits start to increase. So what the self-employment tax is it's essentially FICA tax, which is Social Security, and Medicare tax for the self-employed. So when you have a sole proprietorship, you are your own employer. So you are subject to both the employer portion of the tax and the employee portion of the tax. So the biggest tax surprise that a lot of folks who have sole proprietorships encounter when they have a really good year is they get hit pretty hard with self-employment tax. And there's ways of getting around that we'll get into here in a little bit. And also with a sole proprietorship, there's no asset protection. So you really have to look at, what is your exposure of something going wrong and possibly getting into litigation and so on and so forth. If there's not a whole lot of risk of that, then, and profits are kind of not too excessive in the business, then, a sole proprietorship might be the best bet for you. Next slide. A limited liability company is a hybrid entity that combines the characteristics of a corporation and those of a partnership or sole proprietorship. While the limited liability feature is similar to that of a corporation, the availability of flow-through taxation to the members of an LLC is a feature of partnerships. So we have both single-member LLCs and multi-member LLCs. So if you're a single-member LLC, one person owns it, it's basically treated as a sole proprietorship, but with the asset protection. One thing to remember, though, with an LLC is, with an LLC, you do want separate bank accounts for the business. You do want an EIN. You would basically go to your bank with the EIN number and open up a checking account for the business. you want to respect the LLC as a separate entity. So what that means is you do not want to commingle funds. You do not want to pay personal expenses out of your LLC bank account. I had that happen actually today on a client who had to make an extension payment on their federal taxes, and they called me and said, "Well, I've got all the money in my business account. Can I just write the check out of that for my personal taxes?" And I said, "No, you really don't want to do that. You want to transfer the funds from your business account to your personal account and then write the check." It sounds like an extra step, but it's really really worth it. So, I mean, what happens to folks who have LLCs and they spend the funds and so on to set up an LLC and they just commingle everything? If they were to ever get into a situation where they headed into litigation for whatever reason, the opposing attorney is going to look at that and basically just pierce the corporate veil and just say, look, the LLC was a sham to begin with. It was never a separate entity, and then try to go after your personal assets as well. So always keep an LLC separate from the owner and respect it as a separate entity. I often get so now we're going to get into multi-member LLCs. So multi-member LLCs, which are LLCs with more than one owner, in general are partnerships. So they're generally partnerships and require a separate informational return, not a tax return, but it's an informational return. So what happens in this case, is a partnership return is required. Each member will receive a document called a Schedule K1 from that partnership return, and then will be required to report the individual items on that K1 on their personal returns to pick up their share of income deductions, so on and so forth. So one common question I get a lot about multi-member LLCs is in a situation where a business is set up as an LLC and is owned by a husband and a wife, for instance, together. They can be 50-50 or whatever percentage they each want to be. So I often get a question, well, if it's a married couple, is that a partnership? Or since they're married, can it just be disregarded and just flow right to the personal tax return? Well, the answer to that depends on what state they're in and essentially what state that the LLC is organized in as well. LLCs are governed by state law. So the rules in effect for LLCs apply to whatever laws apply in the state in which they are formed. So you have community property states and you have non-community property states. So in a community property state, the property, in general terms, the property of one spouse is the property of the other. So in this case, if a husband and wife formed an LLC together, both ownership and married, then this would not technically be considered a partnership in that case. In non-community property states, property of each spouse is their own, basically before marriage. After at marriage, again, you get into family law and so on and so forth. But in this case, in a LLC in a non-community property state, this would be considered a partnership. So Georgia, for instance, is not a community property state. So if you form an LLC owned by a married couple, it would be considered a partnership in Georgia. There are about 6 or 7 states that are community property. Georgia's not one of them, but you can Google those and kind of look at those for yourself if you're interested in knowing which states are community property versus non-community property. Next slide. Okay, so owners, so in limited liability companies, the key takeaways, you have owners are generally not personally liable for the company's debts or liabilities. Now, I say personally, I say generally here, okay? Most of the time nowadays, if you go and get funding for a business from a bank or an SBA loan, so on and so forth, they're going to require personal guarantees of the owners. So that's kind of a way that the financial institutions kind of get around from the LLC rules, protecting them against debts of an LLC. Personal guarantees are very, very prevalent nowadays. Regulations surrounding LLCs vary from state to state. An entity can form an LLC. Now, any entity can form an LLC, including individuals and corporations. However, banks and insurance companies cannot. Next slide. So LLCs do not pay taxes. Their profits and losses are passed through to the members who claim on their tax return. Again, very similar, same situation that you have with the sole proprietorship. Single member LLCs are disregarded for tax purposes, which means that all income and losses flow through to the owner's personal tax return, as previously mentioned. All right, liability protection. So it provides liability protection, but again, you want to have separate bank accounts and do not commingle personal and business activities in your business account. Self-employment taxes are still applicable to members who participate in business operations. So, okay, so what I mean there is sometimes there's a participation requirement in order for folks to actually be subject to self-employment taxes, and it's strictly facts and circumstances. You have some LLCs where you have, just for instance, two members, two unrelated members. One member, for instance, does all the sweat work, actually does the work. That individual would be subject to self-employment tax. There could be another member that possibly maybe put in the funding of the LLC, more of like an investor. But really this person has no active participation in the business. They just put money into it, for instance. In that case, I mean, you can really exclude that person from the self-employment tax because there's not really any active participation by that member. All right, next slide. An S corporation is a hybrid of a C corporation and a partnership. It passes income along with other credits, deductions, and losses directly to shareholders without having to pay federal corporate taxes. Usually associated with small businesses, 100 or fewer shareholders. S Corp status effectively gives a business the regular benefits of incorporation while enjoying the tax flow privileges of a partnership due to income passed through to the shareholders. Next slide. Also known as Subchapter S, a type of legal business entity, requirements give a corporation with 100 shareholders or less the benefit of incorporation while being taxed as a partnership. Corporate taxes filed under Subchapter S may pass business income, losses, deductions, and credits to shareholders. Next slide. The shareholders report income and losses on their individual tax returns and pay taxes at ordinary tax rates. So again, an S corporation, there is a separate tax return requirement, regardless if it's one member or multiple members. One of the key benefits of an S corporation is that your net profits are not subject to the self-employment tax like you would have under a partnership LLC type of arrangement. So this is the attractiveness of the S corporation. Shareholders must be individuals, specific trusts and estates, or certain tax-exempt organizations. And again, profits are not subject to self-employment tax, but shareholders are required to take a salary. So there is a reasonable salary requirement with an S corporation. The reason being is you want to pay some FICA and Medicare tax during your life because you want to get the credits, for one day when you become eligible for Medicare and Social Security. Obviously we don't know if the Social Security fund is going to be around forever and ever. We don't know that. And we don't know about Medicare either, but you still want those credits available. I mean, I often hear nightmare stories about people who think that they're slick and they form S corporations, never take a salary. When they get to be 65 and they want to get on Medicare, they go to the Social Security office and they say, we have no record of you ever paying any taxes into the system, so you're not eligible to participate in Medicare and the Social Security system. It does happen. So there is a salary requirement. The requirement, since we're on the subject of a salary, is a quote reasonable salary. There is absolutely no guidance on what constitutes a reasonable salary. There's no general rule for it. Often you have to look at, okay, what would I have to pay somebody to do my job? That's kind of and there's salary guides out there to kind of help you with that. Our general rule or my general rule is that usually your salary should be somewhere around 40% maybe of your net profit from the S corporation, somewhere around there. So what that does is you're only paying FICA and Medicare tax on that 40%, and the other I'm sorry, the other 60% you actually get to avoid paying FICA and Medicare on. So that can actually really add up, if you got the business profit to do it. S corporations are not designed for businesses that experience losses, especially during startup. Losses can be limited as far as what a shareholder can deduct on their personal tax return. So they're not designed for losses. So generally what happens is if you're in a situation where your business requires some capital startup and you're basically going to be bleeding cash for a little bit to get things going, you generally do not want to start off as an S corporation. Generally what we would do is form an LLC. You want to form an LLC because you have to have at a minimum an LLC to actually convert it to an S corporation at some point. You cannot convert a sole proprietorship into an S corporation. So you got to at least have the LLC established. So you would just start up as an LLC, stay as an LLC during those startup years. where your expenses might exceed your revenue. And then at the point where profitability starts to happen, then, we would analyze, at what point should you elect to become an S corporation. And you can essentially elect to be an S corporation at any time. There's no requirement, that says you have to be an S corporation from day one, or you got to be an S corporation within 2 years, 3 years, whatever. You can elect to be an S corporation at any time. I think I've got some more on that in a little bit. So the S corp election is due 2 months and 15 days after the beginning of the year the election is to take effect. LLCs and C corps can elect S status at any time, and there's late election relief. So, for instance, if a business owner has an LLC and wants to elect S corporation status for 2021, that election would have been due on March 15th of 2021. So we're already beyond that. But however, there's still opportunity because the IRS is very, very lenient on late election relief when it comes to S corporations. So you would just file under late election relief. Today is May 17th, so you could still go from today and go retroactively back to January 1st, and more than likely not have a problem. I haven't really heard of anybody ever having a problem after requesting late election relief. So, I mean, you could go back, wait until November, December, and apply for late election relief, going retroactively all the way back to January 1st, and you probably will not have a problem. The only problem you're going to get into if you wait that long into the year would be to actually get you a salary process by the end of the year, because you do want to process a salary with S corporations. So, there's additional administrative costs associated with having an S corporation. There's, a separate informational tax return. It's not really a tax return; it's an informational return. Is required, and then you also have to have, payroll processing. So there's some fees related there to payroll processing. And some folks do it themselves. They do the payroll themselves on QuickBooks, or there's online payroll services out there, or, they may outsource the payroll to their accountant, who can also handle it. The nice thing about the salary requirement as well is, a business owner can then withhold his or her personal income taxes, federal and state, from their salary, and then not have to worry about paying quarterly estimates. And tax planning comes into that. So what can happen here is, the nice thing about S corporations is, S corporations, if you're an S corporation, you should be doing tax planning probably somewhere around at least by November of that year. And an accountant CPA can kind of project what your tax liability is going to be, and then recommend a salary based on that tax liability, and then just have you withhold the tax right then and there, to cover it, and you're pretty much done at that point. You've got your tax paid in all at one time. Now, the funny thing is, or the strange thing is, but it's true, the IRS will actually treats withholding as paid evenly during the year. So you also eliminate the risk of incurring any kind of underpayment penalties by processing a salary. So You can process a salary and withhold tax, say, in December, but it still gets treated as if you had paid it evenly during the whole year. So that's a very nice benefit there. So due to the additional administrative costs associated with an S corporation, it's generally recommended when business profits exceed around $40,000. So if your business profits exceed 40,000, at that point, you're probably in the area where you would want to be an S corporation. Anything below that, it's really just worth sticking with a regular LLC or sole proprietorship and just paying the self-employment tax, because it's just not worth, covering the additional administrative fees associated with an S corporation at that point. All right, next slide. All right, the old standard C corporation is probably one of the oldest types of entities out there. You don't see these a whole lot anymore in the small business realm. C corporations are pretty much, these are like your big, I mean, you don't see them in the small business realm very much. They are out there, but they're not really all that prevalent. A C corporation is basically, you think of the really large corporations, like, your publicly traded corporations, your Walmarts, Home Depots, Lowe's, all those large companies. Those are C corporations. So a C corporation is a legal structure for a corporation in which the owners or shareholders are taxed separately from the entity. So the C corporation is subject to its own tax. The taxing of profits from the business is at both corporate and personal levels, creating a double taxation situation. So you can incur double taxation when it comes to C corporations, which basically means that a corporation is subject to tax on its own profits, and then any distributions to the shareholders that's not salary could be considered a dividend, which is then taxable to the shareholder. And dividends are not deductible to the C corporation. So there's where the double taxation comes in. A corporation pays tax on the profits, and then the shareholders could eventually be exposed to a second layer of tax. So C corps can be compared with S corporations and limited liability companies, among others, which also separate a company's assets from its owners, but with different legal structures and tax treatment. The next slide. C corps legally separates owners or shareholders' assets from income from that of the corporation. C corps limit the liability of investors and firm owners, since the most they can lose in the business failure is the amount they have invested in it. C corporations are mandated to hold annual meetings and have board of directors that is voted on by the shareholders. Again, you got double taxation on dividends. C corporations are not designed to hold appreciative property such as real estate or securities. You do not want to hold property that will go up in value in a C corporation. You can never ever get that property out of the C corporation without triggering corporate level tax. And C corporations do not have a long-term capital gains rate. it's right now, last year was a flat rate of 21%, and it's talking about going up. The new tax act has not been issued yet, but they're talking about it going up, I believe, to, I want to say 26 to 28%, somewhere in there. They're going to raise it back up. So you generally use a C corporation that I've seen under two scenarios. Number one is you want to raise money or raise funds from outside investors. So you think of, anybody's ever watched Shark Tank on CNBC, a situation like that where they're looking for outside investors. Those are typically C corporations. The only other time that I've seen a small business be a C corporation would be if, for example, a executive in a company, for instance, takes early retirement, and decides that he or she wants to start their own business. They're most of the capital, and they might have a real hefty 401k retirement plan, which has all their funds and assets in it to start up the business. There's a way that you can invest 401k funds into a C corporation to help capitalize the business. I've seen that happen a couple of times. I don't know that I recommend it, but it happens. So now that you have a business structure in place, you will be able to properly tax plan. Next slide. Oh, I'm sorry. It looks like I spoke on two slides at once. So you got double taxation and not designed to hold appreciative property. So we mentioned both of that. Next slide. So what is tax planning? Now that your business has been structured properly, let's discuss tax planning. Tax planning is the analysis of a financial situation or plan to ensure that all elements work together to allow you to pay the lowest taxes if possible. A plan that minimizes how much you pay in taxes is referred to as tax efficient. Tax planning should be an essential part of an individual business owner's financial plan. Reduction on the tax liability and maximizing the ability to contribute to retirement plans are crucial for success. Next slide. The whole idea in tax planning is to be proactive, and the goal is to create tax efficient strategies to help business owners grow their business. Make sure you have all of the information needed when starting up a business to get it set up correctly to begin with versus fixing it if done incorrectly. It's a lot easier to get the business set up correctly to begin with than to try to correct it afterwards. Get it right from the get-go, and that's where the tax planning comes into play. What kind of business is it? Service business, whether it's accounting, public relations, a law practice, or selling a tangible product, e-commerce versus retail. What's the liability exposure to the owners? That's a big step in it. Next slide. Tax planning helps to figure out what you owe and what your tax payment will be when you pay your taxes. A mentor of mine several years ago had a tagline in her email signature that said, "Surprises are for your birthday, not for tax day," in her email signature. We don't want people to be surprised by their tax situation. To eliminate surprises, we do a tax projection and run numbers to see how it all pans out in the end. That's what we do as tax advisors and business consultants. Next slide. First is to have a discussion with a tax professional to make sure all the information needed is available in order to do an effective tax plan. At least estimate your personal and business income for the current year. We don't know what's going to happen. The further you go out, things change all the time with tax laws. What's the law now may not be the law a year from now. So it's only recommended that you plan for a year or two out at a time. For instance, right now in 2021, it's really difficult to plan. It's almost impossible because we don't have any guidance right now what's going to happen. It's all pending. Then it's time for the tax professional to do the tax planning and run the numbers and see if there are options available to provide the maximum benefit. An example of an option would be computing depreciation, for instance. There are different methods of computation, and there is planning that can be done around that so that we can take advantage of the certain situations. For instance, if a business owner is in a break-even situation, it might not make sense to over-accelerate depreciation. It might make sense to leave some greater deduction for later. Or another example, we can plan to defer income in some ways with different retirement accounts. We are often called upon when a business owner goes through some kind of event and they don't know the tax consequences of it. One example, are they looking for outside investors to invest in their business, like, the Shark Tank type of deal? You mainly do that with a C Corp setup. Another example is something went wrong. What's their asset exposure? Could they lose their house or other personal assets if something goes wrong? What's the risk in that? Next slide. First is to keep a good track record of financials. You must have valid business records. It's okay if a business owner can do QuickBooks themselves, but they really only want to go that route if they have an accounting background. We see where people think they are doing it correctly, but so many errors affect the tax plan. So we correct the mistakes and the actual results could be different from the plan. Numerous tax planning strategies are available to small business owners, and it's often better left to the professionals, regardless of how simple or complex a tax strategy is, whether it is aimed at the owner's individual's tax situation or at the business itself. It will be based on structuring the strategy to accomplish goals such as reducing the amount of taxable income, lowering your tax rate, controlling the time when the tax must be paid. I think what we mean by there is, you want to plan a proper time, meaning if the tax isn't due until April 15th the next year, then don't pay it until April 15th. It's like a cash flow issue at that time. So it gives you an option, just pay it when you have to pay it. Don't pay it early. You may be able to use that money in the meantime, instead of just leaving it on deposit with the tax agencies. And then claiming any available tax credits. Next slide. If revenue is increasing, which is a good thing, make sure that the business owner tax plans around that. On our monthly accounting clients, if the accountant sees the revenue growing, that triggers me to say, hey, we need to run a tax projection to see what's going on. No surprises. Again, we don't like surprises. I can't stress enough how important it is to have the right knowledge and expertise when it comes to tax planning. There are so many different tax rates and deductions that a business owner may not know about. It's all about knowing what you're looking at. A lot of business owners are not that proficient in accounting and tax and don't want to be. They want to focus on their own business, and that's where the focus should be for them. Next slide. Here are some triggers that can require a new tax projection. before I address any, well, let's talk about that. Here are some triggers that can require a new tax projection. Um, Actually, we're on smart tax tips for small businesses. So some questions that come up would be purchase versus leasing. You get a lot of questions about that. Is it best for me to buy an asset or to lease it? And that can be a copier machine. That could be a an automobile, so on and so forth. Depreciation planning is a big thing. You can plan around that. Sometimes it makes sense to accelerate it. Sometimes it doesn't. And then accelerate income versus deferring income. If you know you're heading into a year where taxes are going to go up, you want to accelerate that income into the prior year before those higher tax rates take effect. All right, next slide. Okay, so before we get to questions, though, I just want to thank Debbie Fitzgerald and Sandra Barth for helping me put this presentation together. So thank you to you both very much. And I guess we're ready for questions. If anybody has questions.
Okay, there are a couple questions in the chat box, and thank you, Chris, for that presentation. So one question says, are there any tax breaks for minority contractors?
Not really special income tax breaks now. I mean, there's really the only breaks that I hear of for minority contractors would be in government contracts. I mean, but that's kind of beyond the scope of the presentation. But not really for income tax purposes. There's not really anything out there for minority owned businesses at this time. Now, there could be on the state side. In Georgia, I'm not aware of any advantages to minority businesses, but probably in some states there probably could be. So I hope that answers the question.
Okay. The next question says, for S Corps, you have a shareholder meeting annually, correct? How do you recommend a small business shared 50-50 between owners, in this case spouses? Could we plan a retreat weekend and it be a tax write-off?
There's no, well, okay, there's no required meeting in an S corporation. For C corporations, there generally is at least one board meeting, but for S corporations, you know, it's okay for the shareholders to have an annual meeting if they're talking about business, and probably, allocate, some portion of those expenses to business. That's kind of facts and circumstances. I mean, you have to really look at what you're doing during those meetings. Is the expense kind of required in order to have the meeting? So that's kind of a facts and circumstances type of a question. So yeah, so the answer to the question, yeah, I mean there could be some deduction there for an annual meeting of S corporation shareholders.
Okay. Does anybody else have any questions? You're welcome to type them into the chat box or unmute your mic at this point. Okay. You mentioned a monthly small business accounting service. Tell me about that.
Yeah, we offer a monthly small business accounting service. We kind of try to do it at a flat fee. We kind of have to determine what the fee is going to be to do it. We generally base that fee on the number of transactions incurred in a month, so that we can kind of determine, the time involved that we're going to be on the project or on the accounting project. So that monthly fee can vary. It just varies on number of transactions. It can vary from $200 a month to and up basically. So generally, most of our clients use QuickBooks. QuickBooks Online. I mean, I'm not going to market QuickBooks, but QuickBooks Online is a decent program. It's getting better. The nice thing about the cloud version or cloud software is that you can often assign your accountant as a user, so the accountant can go in and look at everything real time, and then obviously the business owner can go in there and look at it and pull reports and so on that he or she needs as well. So and there are other programs out there as well that that work. So um, yeah, so I mean that's pretty much. And then uh, we can do the bank reconciliations for you, so on and so forth. I mean, basically, we can do really whatever you need us to do. It's kind of, you can have it however you want it, basically. So, anyway, I hope that answers the question.
Okay. Are there any other questions? Okay, well, thank you so much, Chris, for
Yeah,
presenting, especially since it's tax day. And I know we did not originally, when we first planned this presentation, today was not tax day. So I appreciate you still being willing to do it on a very busy day for you. And
no
I also
problem.
want to thank Debbie for working with us as well. And just a reminder to everyone, we do have 2 more programs in the series. So if you want to register for those, you can go to forsythpl.org. And if you think of any questions, just let me know, and I can reach out to Chris for you. And I hope everybody has a wonderful evening. So thank you.
Great. Thanks, everybody.
Thank you.